Okay, next let's talk about situations where we need to change the strategic asset allocation. If you have a client for any period of time, you know that the SAA is not static, right? Their circumstances may change, and so that's why we review with the client and figure out if there are possible changes that need to be made. So some examples of this: changes in their objectives and constraints. We'll certainly talk about those. Changes in long-term expected beliefs about market conditions. Maybe that comes from you as the manager, maybe that comes from the client. All of those, all the above, can lead to us making changes in the strategic asset allocation. So some examples: economic prospects of the sponsor's business change. So whether we're talking about an individual or an institution, if their ongoing ability to generate income and generate ability to invest in the fund, well, that may change the purpose of the fund itself. An individual investor, if they age, if they start a family, as they get close to retirement, again, as their circumstances change, that's certainly going to change the need for what that portfolio needs to accomplish for them. Another example: the investor has specific expenses to fund, all right? So if something comes along and so there's a big dollar amount that is going to have to exit the fund, well, that's something that needs to be planned for that may need to result in a change in the SAA. So some changes. One thing is we can do, just a list of these. A large inheritance, right? Let's say you have a client, they've had a kind of a standard portfolio, and suddenly they come into a very large sum of money. Well, that's going to change a lot of things, right? It can change the amount of risk that they can tolerate in the portfolio, may change their need for liquidity within the portfolio if they've just gained a bunch of money. So that's certainly going to change the strategic asset allocation. Loss of job or retirement benefits, well, that may increase the need for liquidity, right? We no longer have income coming in for the time being. We may need to change the portfolio for a period of time so that it's more cash invested. New regulations, tax laws, in terms of tax efficiency of the portfolio, we may need to make some changes there as well. Changes in investment committee personnel. So let's say new people come on the investment committee that have a different stance on what the portfolio should be accomplishing. Well, in communication with those people, well, they may look and say, you know what, this portfolio has been wrong right from the beginning, or it's been wrong for the last several years. We need to change the allocation because this is what we think the goals of the portfolio should be. So again, in communication with the client, if that's a committee that changes over time, well, that may change the stance of the portfolio. Regime change, for example, decline in inflation post-1984. So if you had a portfolio from the period 1979 to 1984, you went through a period of time where inflation was on the order of 8, 9, 10% per year in some of those years. Well, the Federal Reserve, starting in the 79 to 82 period, and certainly since then, has worked hard to squash inflation and keep it below 2%. And it's actually been quite successful in doing that. So no longer having to plan for significant high inflation as we did during that period of time, well, that's certainly going to change the asset allocation of the portfolio. Then finally, a regime change such as 2008, 2009, right? Having gone through the financial crisis and seen what that did to certain segments of the market, like mortgage-backed securities, for example, well, that certainly made people cast a wary eye towards those types of assets and maybe change their fixed income allocation, for example, after they came through that period. So as we go through these experiences and we see how it affects our portfolio, some risks that maybe we didn't sort of fully realize, well, then maybe we're more cautious going forward. All right, so let's walk through an illustration, the Portal Endowment. The Portal Endowment Fund operates in perpetuity to support projects to improve third world living conditions. The risk and return objectives are aggressive because the founder is committed to leaving his estate to the fund. Okay, so first of all, endowments do tend to have a great ability to take on risk. They only need to spend what they decide they want to spend. The rest of the portfolio remains invested. So they can invest in illiquid securities, alternative securities, because they have a very long-term perspective. Now, on top of this, Will Portal has committed his estate to the fund, so when he passes on, presumably a very large sum of money is going to come to the portfolio. So as a result, this is a fund that can be invested very aggressively. So this would conservatively quadruple the fund and is expected in 5 years. Now, I don't know why it's expected in exactly 5 years, but I guess we have to put a number on it for this example, so let's do that. In the meantime, annual fund distributions are only 10% of market value. So the remaining 90% of the portfolio remains invested, and that's met by annual contributions to the fund from Portal. So in other words, the existing portfolio isn't even being tapped for that 10%. That 10% is coming out of sort of operating funds, courtesy of Will Portal. So what does that mean? let's say there's new circumstances, okay? So the fund's asset allocation is very aggressive, focusing on high return and earning liquidity premiums. So they can invest in illiquid securities because they know they're not going to have to sell them in a rush. So by owning these illiquid securities, over time they're going to earn that liquidity premium. In other words, that higher rate of return that comes from taking on that liquidity risk. All right, now the new circumstances. A devastating economic depression has just destroyed Portal's wealth, and now he will leave nothing to the fund. How does that change things? Well, if that very large allocation to the fund is no longer going to be coming, not surprisingly, that means the risk tolerance of this portfolio is going to be dropping a little bit, and its liquidity needs are going to be increasing. So they have to think about that in terms of the risk and return objectives, the liquidity needs, the asset allocation. Exactly. So what are we going to do? Take a look at how the fund's risk and return objectives will change. Okay, they probably can't be as aggressive as they were in the past, so they're going to have to accept a lower level of risk and correspondingly a lower level of return as a result of that loss of the major inflows, not only annually from Will Portal, but also from the estate endowment from Will Portal in the future. Now, what does that mean for its liquidity needs? If those cash flows are not coming in, well, then that means it's going to have a higher need for liquidity due to those lack of inflows and those high annual 10% distributions. So the portfolio, which may have been perhaps even close to 100% in equities and alternatives, now is going to have more allocated in cash. Now, how about its asset allocation in general? Well, yeah, what are we going to be doing here? We're going to shift to a more conservative asset mix, more liquid assets, more in cash as a result. Okay. So now let's talk about tactical asset allocation. So the big picture is the strategic asset allocation, right? That asset allocation decision. The tactical asset allocation, we can think of that more as the asset selection decision, right? Where do we maybe stray from the strategic asset allocation, or what activities do we take within the strategic asset allocation with the goal of trying to add some alpha to the portfolio? So we can do this to try and exploit short-term economic or market conditions. And then the size of those deviations, well, they do need at the end of the day to be consistent with portfolio risk and other constraints. But again, we're looking to capture different advantages as they present themselves. So we understand that as we try and do this, it is going to increase trading costs. It's also going to make us less tax efficient because the more trading we do, if we're selling assets that have gained, well then yeah, we're going to have capital gains taxes, plus increased concentration of risk in specific assets of the portfolio. That last piece quite often gets overlooked because if our tactical asset allocation causes us to be overweighted in one sector, one asset class, or even one individual stock or one individual asset, well then yeah, we're going to have a less diversified portfolio, and that's going to present its own set of risks as well. Okay, so let's evaluate this. What we want to do is we want to compare the Sharpe ratio under using the tactical asset allocation versus just the standard strategic asset allocation. And so what we want to do is obviously, first of all, if we're engaging in these tactics, we want to end up with a higher Sharpe ratio, right? We want to use these techniques to get more bang for our buck, obviously. So we're going to calculate the information ratio, right? That's the alpha that we generate relative to the tracking error that we have in relation to the strategic asset allocation, or we can calculate the T-stat of the excess realized returns relative to the strategic asset allocation. In other words, are we gaining or are we not? Is this worth our while, or should we just sit on our strategic asset allocation in a more passive manner? So we compare the two, compute the realized risk and return, compare it to portfolios lying on the strategic asset allocation's efficient frontier, perform that attribution analysis to get a sense of, are we really adding value here? And so look at that excess return to the extent that we have it, try and identify where that contribution is coming from. So we may actually take a variety of tactics, and in general, we're adding some alpha, but maybe we're better in some places than others. So if we look at that alpha and we sort of break it apart, perform performance attribution analysis, we can say, boy, we're really good at this type of trade, but we should stop looking for alpha here because we're apparently not very good at it. Okay, so some approaches to tactical asset allocation. We can be discretionary. Okay, so discretionary basically means it's kind of more ad hoc. Wherever we see opportunities, we try and jump on them. On the other hand, we could take a more systematic approach. An example of that would be factor tilts. So I have a broadly diversified portfolio in equities, let's say, but let's say over the next year, I think growth is going to outperform value. All right, so I take a shift towards more growth stocks versus value stocks, or I think large caps are going to outperform small caps, or I think there's going to be a momentum shift or a reversal shift, whatever. Some sort of factor tilt that gives me kind of a systematic shift in my portfolio, just as an example. If I have a systematic tilt, well, again, those next two boxes, yeah, do I take a value shift versus a growth shift, momentum versus reversal, large cap versus small cap? Well, those are those three factors in that Fama French three-factor model, right? So those are kind of standard examples for systematic tactical asset allocation. Where do we tilt the portfolio with the goal towards adding some alpha? Okay, on the other hand, if we're doing it in a discretionary fashion, okay, well, what this is going to do, it's going to rely on the skill of the manager. So it's going to be a little bit more ad hoc based upon where the skill level of the manager resides and in what markets and what assets, what sectors. And so it's going to be a little bit more qualitative based on their skill set. So some possible inputs that they may use here, may use some macroeconomic data. Certainly we may study bond yields to try and capture advantages in the bond markets, as well as with credit spreads, monetary policy, GDP growth, right? So whether we're looking at fixed income or looking at that GDP data, certainly that feeds into the equity markets. We may use that data to try and see whether one market is better than another, or maybe whether there's certain sectors within those markets that give us a potential advantage. Fundamental data, so deviations in long-run average, let's say price-to-earnings ratio, price-to-book ratios, not only on a market-wide basis, but maybe on a security-by-security basis, throw dividend yield in there as well. Again, we're looking for situations where it looks like we're deviating from what the true value should be, whether that's a long-run average or maybe that's a value that comes from our own macroeconomic and econometric models. Whatever the case is, that generates what we think is an investment opportunity. We may also look at some market sentiment data. So margin borrowing, if there's a large amount of margin borrowing, that means people are borrowing money to make stock trades so they can take bigger trades into their portfolios. Well, that's a sign of exuberance in the market. And so depending upon if you think that generates momentum, well, then you want to climb on the back of that and buy more equities. On the other hand, if you're a contrarian, you say, boy, these people that are doing this margin trading, they're idiots. That means that's a sign that the market has peaked and is about to turn the other way. Depends upon sort of which perspective you take. Short interest, basically what percentage of a company's stock is currently being sold short. That's often seen, obviously, as a bearish indicator if that number is getting bigger. Volatility indexes, right? We can look at the VIX, right? The fear index, as that often is called. Again, all of these things, we're trying to find ways to show opportunities to us that we can then take advantage of in our tactical asset allocation. Now, going back to a systematic approach to TAA. Again, we're using these quantitative signals. So I mentioned these factor tilts, two main approaches, value versus growth, momentum versus reversal. Sort of wherever we think we are on that range for each one of those parameters, well, we can tilt the portfolio in specific ways to try and capture that. Next thing, if I look at that systematic type of tactical asset allocation, some value indicators, well, that book to market ratio, that's something that we look very commonly at with equities, but we can also look at dividends, we can also look at cash flow yields. Again, we're trying to get a sense of where value stocks are versus growth stocks and which one sort of presents a greater amount of advantage to us. If I'm looking at fixed income, well, I can do this in the fixed income markets. I may look at yield spreads over a risk-free rate, giving us a sense of, okay, do I think corporate bonds are going to outperform treasuries based on those spreads? I can also look at currency, short-term interest rate differential. So if I'm looking to make carry trades, for example, if I see one market offers me a higher interest rate, and I don't think that's going to be met with a corresponding decline in the exchange rate of that currency, well, then maybe I take advantage of that higher interest rate over that short term. I can also look at commodities, the roll yield and backwardation. Not going to talk about that in detail right here, but you can certainly get that from the readings. Basically looking at backwardation and contango, F0 versus S0, the future price today versus the spot price today. Some momentum indicators. Well, we talked about there are momentum and reversal periods in markets. Typically, we think of momentum as being a 1 to 2 year phenomenon. The trend, if it's a trend upward, we expect it to continue to be upward. If it's a trend that's been downward below the intrinsic value, we expect that to continue as well. So then the question is, where is that inflection point? After a 12-month trend or a 24-month trend, whichever one you think is valid, well, then you're sort of looking and expecting for that reversal. And so this momentum and reversal pattern, well, this certainly is going to play a role in moving averages, right? If I take a short run moving average versus a long run moving average, well, as that momentum and reversal phenomenon occurs, well, then the short run and long run moving averages are going to intersect with one another. So wherever they hit that crossover point, if I look at a shorter term moving average and it crosses above the longer-term moving average, that indicates an uptrend. It indicates that in the short run, we expect stocks to go higher. We're hitting an upward momentum trend. If we're crossing it from below, well then, we're expecting a reversal. We're expecting a downtrend as a result.